Stock market movements aren't random. They follow a hidden blueprint created by the biggest players, and today you'll learn to see it. Every candle, breakout, and breakdown you see on your charts are all connected pieces of the same underlying market force. The biggest players in the market don't just participate. They actively shape movements, patterns, and price action with their massive capital. These major players leave behind clear clues that reveal exactly where the smart money is flowing. All of these clues are stored in one powerful place, the option chain, your window into what the big money is doing. While beginners ignore the option chain completely, professionals study it every single day to gain their edge. That place is the option chain. Now that you know what the option chain is, it's time to learn how to actually read this market blueprint. Once you understand the option chain, you'll never trade blindly again. Knowledge replaces guesswork. Welcome to Money Mastery, your step-by-step guide to financial freedom and wealth creation. Today, I'm breaking down the option chain using a cinematic approach that combines simplicity with real power. Let's explore what the option chain really is and why it's the most powerful tool in options trading. The option chain displays every strike price, every call option, and every put option in one comprehensive table. It reveals where buyers are interested, where sellers dominate, how money flows, and how many positions are currently open. The option chain tracks position changes minute by minute and shows where the market is likely to turn. Think of it like an X-ray scan of the market's bones, muscles, and heartbeat, all at once. Now let's break down how the option chain is structured. Call options on the left are used when traders expect prices to rise, while put options on the right are for when they expect prices to fall. This is not just random data, it's a live negotiation between bulls and bears, a constant tug of war happening at every price level. Let's examine the most important columns you need to understand. Each strike price represents a battlefield where bulls and bears position their troops. Some levels are lightly guarded, others defended like a fortress. Premium tells you the option's cost, how much fear is priced in, and how much movement traders expect. When premium spikes, it means traders feel something big is coming. Open interest is the backbone of the option chain, showing how many total positions exist. High call open interest means bears are defending resistance, betting price won't rise above that strike. High put open interest means bulls are building support, confident price won't fall below that level. Open interest provides consistency, reveals true commitment, and shows where heavy capital is positioned. OI doesn't lie, doesn't trick you, doesn't change every second like premium. It shows true commitment of traders with heavy capital. Change in open interest reveals the real-time story unfolding throughout the trading session. When call open interest increases, bears enter defense mode and market resistance forms at that strike. When put open interest increases, bulls enter support mode and the market floor strengthens at that level. When both call and put open interest rise together, it signals sideways market expectation. When both call and put open interest fall together, a big breakout is loading. Change in open interest is the pulse of the market. Volume measures activity level, tension intensity, and signals when the battle has begun at a strike. When volume spikes, it means the fight has begun at that strike. High implied volatility signals fear, uncertainty, and chaos, while low IV indicates calm and predictable movements. Reading 4 helps you avoid dangerous traps. The option chain reveals critical support and resistance levels through open interest concentrations. Support levels appear at strikes with the highest put open interest, where sellers risk big money defending that floor. Resistance levels appear at strikes with the highest call open interest, where sellers bet price won't rise higher. These levels aren't random. They're created by traders risking crores of rupees, forming strong psychological barriers in the market. Let's see how combining option chain signals helps predict the market's next move. Bullish signs include put open interest rising, call open interest falling, and price rising toward resistance. Bearish signs include call open interest rising, put open interest falling, and price slipping towards support. When both open interest levels rise, the market becomes range locked between strong boundaries. When both open interest levels suddenly fall, a directional explosion is coming as traders exit positions. Here's a real market example showing how to read multiple signals together. With highest put open interest at 21,800, highest call open interest at 22,000, and current price at 21,900, the market sits compressed between two walls. This means the market is sitting inside a pressure cooker. Whichever wall cracks first will decide the next trend. If put open interest increases at 21,800, bulls defend that level, support strengthens, and upward pressure builds. If call open interest increases at 22,000, bears defend that ceiling, resistance strengthens, and downward pressure builds. When both open interest levels rise at their strikes, the market establishes a defined range trading zone. When both open interest levels suddenly collapse, an explosion is incoming as position traders exit simultaneously. Now let's explore practical trading strategies using option chain analysis. In the breakout strategy, when price touches an open interest wall, that open interest decreases, volume increases, and the breakout is confirmed. This confirms that big money has removed their defense. The breakout is real. Range-bound strategies like straddles, strangles, iron condors, and credit spreads thrive when price stays between highest put and call open interest. This is where option sellers make the most consistent income. Strong uptrend confirmation comes when price makes higher lows, put open interest rises, and call open interest falls together. Let's cover the critical mistakes that destroy trading accounts. Trading based only on premium, ignoring open interest shifts, not checking IV, blindly trusting highest open interest, having no stop loss, and chasing strikes far from open interest levels are all account destroyers. These mistakes destroy accounts faster than anything else. Let's bring everything together in this final message. Option chain is not just numbers. It's the language of the market, a language spoken by the biggest players that reveals everything before it happens. Once you learn this language, the market becomes predictable, the noise disappears, and clarity begins. If this video shifted how you see the markets, hit that like button and share it with every trader you know. Subscribe to Money Mastery for step-by-step trading education that guides you toward financial freedom and wealth creation. Next up, we're diving into option chain strategies that professionals use every day. Trust me, that next video will completely transform the way you trade.